Let's start off. Lots of data to talk about really here. And of course, some data came out this morning. The newest consumer price index number, which is of course one of the leading measurements of inflation, came out this morning showing consumer prices rose 2.9% year over year. What's your interpretation of this number along with some of the other data that came out this morning?
Well, the inflation's been foremost on our mind for some time now. As everybody knows, the Federal Reserve Act gives the Fed two jobs, what we call the dual mandate, which is to stabilize prices and maximize employment. And for several years, we've been doing completely fine, better than fine on the employment side of the mandate, and worse than fine on the inflation side of the mandate. So we've been trying to get the inflation rate down, and I think it's important to note the inflation rate fell in the last year and a half dramatically from its heights in an almost unprecedented way. It's one of the biggest drops in the inflation rate that we've experienced in U.S. history in a single year without a recession. That is unprecedented, and normally cutting the inflation rate requires a big increase in unemployment, and we didn't have that. Now, that said, we experienced a bump up in inflation in the first quarter of last year. It's too early in the day to delve too far into the weeds about seasonal adjustments of price indices, but we are experiencing multiple years in a row now where inflation is lower in the second half of the year and higher in the sort of the first quarter of the year. So we're trying to think those through. I still see continued progress in that it's important to take the long view on inflation. It's a noisy series, so any one month take with a grain of salt. Multiple months take as being a trend. And the trend continues to be improvement in inflation. We have a 2% inflation target. That's for a slightly different measure of inflation. It's not CPI inflation, it's personal consumption expenditure inflation. And for the last 6 months, that PCE inflation has been running very close to the 2% target. So I'm still optimistic for 2025 that we can continue growing and have a soft landing. I have been describing it as that the golden path was possible, but there are a lot of uncertainties, as you know. There's been an uptick in business confidence that we've observed since the election, but there's also an uptick in uncertainty, whether it's around geopolitics, around fiscal policies, or around overall economic conditions. That I think this number is somewhat encouraging and somewhat discouraging, and in partly equal measure, depending on which parts of it you look at.
Spoken like a true economist, partly encouraging and somewhat discouraging, right?
Well, let's take a second to look at what those components are. The encouraging part, and why I still think that we are on path to get to 2% inflation, is the recent months, the new months that come in. As you know, when we're quoting average inflation, all of those that bump up at the beginning of last year is going to fall out the back. We have 12 months of inflation. Only 1 month is new. The 11 months that go into the calculation, we already know them. And so I think that the newer months are giving encouraging signs, and that if you break out the components of where the core inflation comes from, where you've got services, housing, and goods, the biggest puzzle that we've been facing for the last couple of years is that housing inflation has been dramatically higher than it was pre-COVID. Goods inflation was kind of back down where it was before, which is mild deflation. Services inflation was still elevated, but is down a bit, and approaching where it was. And housing's been the thing that's been well above where it was, and we've been making steady progress now for several months on housing inflation. So those parts are encouraging, and that's why I still think we're on path. The part that's discouraging is we are seeing a little bit of sign of this same seasonal pattern that we've had a much improved second half of the year, but now are we going to go through this same seasonal thing in the first quarter of next year? We're going to have to see how that plays out. The key element the Fed is looking for is this: is there a sign that the economy is overheating, or are we stabilizing at kind of a full employment sort of a level?
Mm-hmm. You mentioned in your comments earlier, obviously we have a new president, new administration coming in, so businesses and the banking industry certainly have a sense of optimism, hoping for greater deregulation. But coming with the new administration, and certainly a lot of the issues President Trump ran on come with some economic concerns, or at least questions about what is going to happen once he takes offices and the specific policies start to take shape. What do you think a President Trump administration is going to mean in terms of how it impacts the Fed's decision making? Lots of talk about tariffs, lots of talk about different immigration policies. As you mentioned, there are geopolitical concerns, leadership changes happening in other countries in addition to our own. How does all of that factor in, and how does the Fed react to all of this change?
Yeah, look, that's quite a list, and I like the way you phrased it. It gave a nice intro to my thing is, the Midwest motto: there is no bad weather, there is only bad clothing. And
right.
You tell me the conditions, and I'll tell you what jacket to put on. That is, in my view, how the Fed's approach should be to fiscal policy and decisions that come out of administration. Those are the conditions that we are given, and conditions change all the time. Our job is to think through scenarios, and what we do is look at the dual mandate. It's not an easy job, but it's a simple to understand job. Anything that's going to affect employment or prices, we are, by law, that's what we have to think about. But we don't weigh in on, let's call it, political prognostication of what's going to be proposed and what are the probabilities that it's going to be passed. Anything that's going to affect prices, we got to think about it. And we're coming out of a period where inflation was way higher than we pledged we would get it to. So if Congress and the president begin drafting policies that are going to raise prices, we got to think about that. The one thing I want to caution everybody is what will matter is the impact of policies taken as a whole, not some individual policy. So when there are people talking about, well, if we had a large tax cut, would that overheat the economy because it would be a stimulus? You can't really answer the question of what will be the impact of a tax cut unless you are also asking what's going to happen on the spending side. And so if the Department of Government Efficiency or in the proposals that I've seen, they've said that they might cut government spending by up to $5 trillion, then we would have to think through all of those scenarios on net. But we only do so, I guess you'd call it indirectly. We do so of, if it's going to affect prices or employment, then the law says we have to think about that for monetary policy.
Mm-hmm. Sure. So a lot obviously goes into what can affect employment and prices, as you noted, and we already discussed some of this change coming forward. Certainly supply chains, and I've heard in some of your prior interviews, we talk a lot about supply chains. There's many things that can happen, including natural disasters that can affect supply chains. One of the questions coming in from the audience is, how do you think the California wildfires will affect the economy or inflation over the next 12 to 24 months, if at all? Certainly
Yeah,
related to that, there was the
yeah,
longshoremen strike that was
yeah.
threatened. They were going to strike starting today. It sounded like they'd reached an agreement, so I think we're averting that crisis. But talk a little bit about supply chain issues as well as the natural disaster in California and how that can impact
Okay,
employment and pricing.
you got a cluster of nasties in there. Um, and in a way, I think let's start with the issue of supply chain and then let's move to thinking about natural disasters.
Okay.
I think that the thing that made this business cycle, both down and up, so different than previous business cycles has a lot to do with the supply side of the economy and especially supply chains. That normally we think of the business cycle as being a demand driven kind of thing. And first from COVID, uh, and then from the healing of the broken supply chain from COVID, it enabled that supply chain healing is, I think, in large part what enabled us to get inflation down without there being a recession. It wasn't about demand. We could kind of get some free fixes to come along with it. We saw when the first threatened strike of the longshoremen came into place, a potential threat that looked a lot like damage to the supply chain that we saw in COVID. And the one thing that I'll emphasize that we learned from the COVID experience, and I wonder is it going to apply now, is that team transitory was really best thought of as team supply shock. And as someone described it, Steve Leisman from CNBC described it, he said, it turns out team transitory was right all along, that the supply chain healing was the reason that people thought that the inflation shock would be transitory. But the supply chain is so much more integrated, complicated, and longer extended than we understood, that when the computer chips were in short supply, and that affected electronic components, and the electronic components then affected cars, and then cars affected delivery companies, and then that moving down the chain just took a lot longer than we knew it was going to. And so when I see that, I'm thankful that the longshoreman strike is hopefully not going to take place. I do wonder when we have big fires in California, if they are long-lived and extended, are they going to interfere with the ports coming in from the West Coast, or can they just divert to different ports? That I immediately think of that. You've seen it have an immediate impact on the food chain because so much of our agricultural activity is coming out of Central Valley in California. But at the end of the day, if you're kind of saying what keeps you up at night, I'll just reiterate, the Fed's job is to not sleep at night. We're on the night watch. We have to sleep in the daytime.
Yeah.
So I do think we need to think through all these scenarios because it does feel like natural disasters are getting more frequent. And those natural disasters are more like hits to the supply side. Almost always when you think about supply side shocks like fires, hurricanes, tornadoes, etc., something about the length makes a big difference. So if they get the fires under control in a short period of time, there can be a sense in which it has a very direct negative impact on the people affected. In a kind of a bizarro universe, in the immediate term, can have a rebound to the local economy, because if you burn down a house and then rebuild a new one, the GDP numbers don't count the burning down of the house as a negative. They're just counting new activity for the year. But that said, over the long term, these natural disasters, I think, do affect people's choices about where they want to live, people's choices about how they're going to adjust to the risks, and we'll just have to see how those ones play out over the long term.
Mm-hmm. Yep. Couple other questions have come in as well. Given the economy growth has outperformed many expectations, what impact do you think government spending has on growth? Is there further unspent funding that has still yet to flow through the economy that will continue to bolster growth?
We've tried to think that through here at Chicago Fed, just in the sense of, do you think the economy is going to overheat? Because we've had pretty robust growth. Consumer spending in particular has been predicted to fall quarter after quarter by a bunch of people. You remember, as we came into 2023, 100% of economists forecast that there would be a recession in 23, and there wasn't. In 24, they keep saying, the consumer's going to run out of money. We've now gone through a Christmas season that in the forecast was meant to be weak, but it turned out was a blockbuster season. And now we're asking the question, will it continue, or was there a kind of pulling forward of Q1 25 into the Christmas season? I don't know that government spending, at least our own estimates are that there's not a large pot of government money still sitting, excess savings style, that threatens to overheat the economy in the short run. My take on it is that it's going to be a more steady pace. That said, everything's delta off last year, if you want to think of it that way. So the era of $2 trillion of stimulus, that's a plus 2 trillion. Then it becomes a minus 2 trillion the next year, and then it's zero, if it's a one-time thing. So that's partly, we always got to think through this, what's a lasting and what's a temporary. And the thing with government spending is in the same space. And the only other thing I'll add is that when you see the survey of professional forecasters, or you see private sector surveys of economic activity, they have already incorporated usually an estimate of what they think government spending is going to be. So for it to disrupt the forecast, it really needs to be something that's very different from what's anticipated.
Mm-hmm. Right. Well, and along those lines a bit, there's obviously a lot of data we've been talking about. I've heard you quoted before in other interviews saying it's a mistake to only look backwards. You also have to be
Yes.
forward thinking at the same time. How do you really accomplish that? Data often is a retrospective measure. Trends might point to some and give you a hint about what the future might look like when you look at trends and data, but how do you really accomplish some of that yourself?
Look, you have to, and I like that there are many things I could have said in the past that I would be embarrassed that you were bringing up. I'm not embarrassed about that one at all. I absolutely think that if you're just backward looking and you're not looking at leading indicators and trying to run through scenarios, you threaten to make a big mistake, in my opinion, on monetary policy. And let me back us up a year or so to what was a controversy. There was a controversy over, can inflation fall if wage growth is as high as what's in the data? And our analysis at Chicago Fed was that wage growth is a leading indicator of price inflation because prices tend to move quicker than wages do. Wages are stickier in our language. And therefore, in the long run, wage growth needed to be consistent with 2% inflation. But there was no sense, or at least there's a relatively less of a sense, that you should take if you see the monthly wage growth coming in, that you should take that backward looking number as a sign, that means that the next inflation can't come down. It proved that to be forward looking proved to be quite important because inflation, as I say, did come down, even though wage growth was high. And I think the only way you can do that is to think through the economics. That was kind of the heart of your question, sounded like, well, how do you really do that? How do you predict the future? You can't predict the future that well. But thinking through the economics and thinking through who are the industries on the margin, I find helpful. So the Fed really has only one tool, which is credit conditions. We can tighten the interest rate or loosen the interest rate. And as I say, it's basically a screwdriver. And if what happens is the handle on your dishwasher is loose, then our tools are great for that. If what you need is to make breakfast, our tools aren't that great for that. And so looking at the most interest rate sensitive sectors of the economy, which is where you would think that the immediate impact of loosening or tightening interest rates occurs, to me, I find that helpful as a way to figure it out. And taking the long view and trying to figure out what's the thread, not being so data point dependent, as sometimes it feels like the stock market or other market observers can be a little, they can be a little more agitated about monthly numbers than I think is warranted.
Yeah, stock market certainly moves up and down quickly on a variety of data.
Look, I get it. That's their business model. They want to be instantaneously there. It's just the day trader's timetable is totally different from the central banker's timetable.
Sure. Another question from the audience, is it realistic to assume that the long-term inflation target will remain only at 2%?
I think so. We stated when the United States formally adopted a 2% inflation target, which I think is around 2012 or something like that. I wasn't at the Fed. And actually, if you go back and look, I was kind of publicly critical of adopting 2.00 as a target because my logic was this is a noisy series, and that connotes a level of precision that we don't have. So if I asked you, how long would it take you, given monthly observations of inflation, with the variability that we observe on the monthly, with the plus or minus margin of error that's on the inflation rate, how long would it take you to tell the difference between 2.0 and 2.1? And the answer is decades. You'd have to get, even if you knew that the process was generating that, it's just a noisy series. Now, that said, once you make a promise to the public as a central bank that you have a target of 2%, now that is a sacred covenant. And the fact that we had inflation in this country getting almost to double digits, and the inflation expectations in the marketplace and in surveys, where you ask people, what do you think the inflation rate will be 5 years from now? And that basically never went up, even as actual inflation was approaching 10%. I changed my mind. They convinced me that the 2% target is an anchor that people believed the Fed when it said it said, pay no attention to the actual inflation rate right now. We will get it back to 2%. And so I think you got to do your job before anybody can start thinking about having a different job. So I'm pretty confident that we will get it to 2%, and that's what we should do, because that's a promise we made.
Yeah, and you're right. It's a marker of confidence for the public to be consistent there. So I get that. Do you have thoughts on on the impact of the growth in M2 and any impact upon the spike in inflation?
Okay, so the old school monetarists like Milton Friedman, who I did meet at the University of Chicago. He had left
Very
long
cool.
before I started at the University of Chicago, but he did come back, and I did meet him one time. Uh, they were concerned with monetary aggregates like M2 as an indicator of the tightness of monetary policy, and indicator for inflation. The only thing I would tell you is that virtually no economists follow that old form monetarism anymore, because the financial system and payments and what is the nature of money itself has so fundamentally changed that the M2 aggregate is no longer, if you look at it, its correlation with inflation, or its correlation with economic output, it largely broke down a fairly long time ago. So we definitely think about the credit conditions, and we definitely think about the balance sheet and the impact that it has on the economy. But I tend not to look directly at M2 anymore, because M2 is like currency plus checking accounts plus a variety of things, which in total are a very small share of transactions now compared with what they were 50 years ago. So I don't find it as helpful.
Hmm. That makes sense. You mentioned earlier in response to one of my other questions about, the data that you most closely follow is the data that's most impacted by the one tool that you have in influencing credit conditions. Do you look at credit card and auto loan delinquencies as
Yes.
part of that set of data?
Yes, absolutely. And people started asking me as soon as I got here, "Are you a hawk or a dove?" I said, "Look, I'm not a bird. I'm a data dog. That's my thing. I look at all the data." And the delinquencies, um, auto delinquencies, credit card delinquencies, and others, as you know, have been rising.
Mhm.
And they've now risen to a level we've had on many series, from unemployment to credit card delinquencies to a bunch of things, a very unusual period in which directionally things were deteriorating, but the level wasn't bad. Okay, so the unemployment rate was up almost a full percentage point from its lows. If you look in the history of this, since we've been keeping the data, in periods in which the unemployment rate has risen a full percentage point, how many times does it stop versus just keep getting worse? And the answer is, it almost always keeps getting worse. That's almost always a sign of the beginning of a recession. And likewise, delinquencies, bankruptcies, credit card delinquencies, when you see those rising, that has historically been a bad sign that the economy is about to go into recession. But like I say, this business cycle that we just went through looks nothing like previous business cycles. So we have been trying to figure out what to make of it. That said, now with the delinquencies, they were rising, but the level wasn't high. Now the level is pretty high. So that is in the full portfolio of data. That side, that area of the house is of some concern to me.
Mhm. Today's data showed, some, as we talked earlier, some positive signs here for inflation, but also showed quite an increase, at least I thought, in energy prices, the
Yes.
2.6% increase in energy prices. And as we sit in the upper Midwest in ridiculously cold weather, and, you talked earlier about what jacket to put on. I think you need about two or three to combat the cold weather today. Do you have any concern, as we continue to go through winter in the upper Midwest about energy prices, not just for gasoline, for automobiles, but also utility and energy in that
Yeah,
regard?
look, for sure. And let's separate it into two parts of I'm a dad, with a mom who has an opinion about energy prices. And I'm also a central banker who's trying to think through the macroeconomy. We tend to look at core inflation, that is excluding food and excluding energy, because food and energy are highly variable. And so we tend to think they don't give as great of an indicator of what's the underlying state of overheating in the economy. Drive my mom crazy when I say, yeah, we don't look at that. She's like, what do you mean you don't look at that? That's all I look at. So from a personal perspective, high energy prices are problematic going into the winter and annoying when you fill up the tank or when you're getting your electric bill or what have you. That said, in the macro setting of monetary policy, we're going to tend to weight that less because it is so variable. If you look back over the last 6 months, we've had multiple episodes where energy price inflation was extremely low or even deflationary. And so that made the headline number more up and down than we're comfortable with. I do think it's worth thinking about energy prices as an input to the economy. If there was an expansion of war in the Middle East or others, and you saw the price of oil skyrocket again, we kind of have a well-documented history. We know what happens when the price of energy goes up a lot in the short run, and it's nothing good. It's like a negative supply shock. So I monitor that both as a parent and as an economist.
Well, I've often wondered, I have an economics degree, undergrad degree. I'm, not in that field at all. And so I haven't followed it as closely. But I do wonder, is there any correlation between food and energy prices, which are what the average consumer will use their wages to pay for first, as opposed to credit cards, like we talked about a few moments ago? And, are there reasons tied to food and energy pricing that are causing credit card delinquencies to go up when you have a situation where unemployment is rather low? So you presumably have, wage earners that still have a full-time job, but more of their dollars going to those costs. So I've always struggled with trying to
worth
rationalize
examination. And many of your members or the people signing in probably have a localized view from their own customer base of what's driving some of these trends. I think the credit card delinquencies, as an example, auto delinquencies, tend to be concentrated at lower parts of the income distribution, if you want to think of it that way. And it has been a harder hit lately in the parts of the economy that are most at risk in that sense. If you have a lot of stock market wealth, the stock market has been way up, so the whatever's the equivalent of credit card delinquencies of people with stock market wealth, you might expect it not to have increased much at all. How that plays out into the consumer spending space, which is sort of the basis of your question, is kind of a hypothesis of consumer spending would be tied to those food and energy inflation. It might be, but it's kind of leading us back into this relatively recent battle over the vibes and the actual numbers, which is, if you looked, if I told you the last 6 months inflation rate has been basically around 2%. The unemployment rate is around 4%. GDP growth, we'd had no recession, stuff's growing strongly, you'd say those objective market conditions look pretty good. And if you go to the consumer sentiment, they're overwhelmingly the economy stinks. And so we've been trying to figure out, why are the vibes so different and what do we make of that? First thing to observe, I told you, Federal Reserve Act tells us we have to look at the actual numbers. We have this dual mandate. We're out looking at the job market and the inflation rate. That's what we have to pay attention to. We always cared about the vibes because they were an indicator, leading indicator of what people's spending levels were going to be. And that has broken down. So now the vibes are not nearly as good a predictor as what people's actual spending is going to be. And sadly, it does seem like there's been a partisanization of everything, including consumer sentiment data. So on the day Joe Biden wins the election in 2020, Republican consumer confidence, even just on the statement of how is the economy right now, goes way down, and Democrats goes way up. And Donald Trump wins, and the exact opposite happens. You probably saw in the University of Michigan survey, there seems to be some consumer sentiment thing that is tied to the to politics, and that's not a very good indicator of how much they're going to actually spend. People of both parties have continued spending and have continued to have income growth that backs up the spending.
Right, very true. Within the Chicago Fed district, what industries or sectors do you see as very strong and healthy? And are there any sectors that you are concerned about or might be showing weakness?
The upper Midwest in general. So 7th district doesn't totally overlap with the folks on this call. Our district is 90% of Iowa, Wisconsin, Illinois, Indiana, Michigan. We're kind of heart of the upper Midwest. Some of your viewers are in the Minneapolis district, and that's okay. The president there, Neil Kashkari, is a great friend. Midwest has been for some time much more manufacturing intensive than the rest of the economy. So, and especially auto intensive in the 7th district. But how manufacturing does is very much tied with how the Midwest does. We've been having slower population growth in the Midwest than in the rest of the country. That's not a secret. You know, since the invention of air conditioning, hot places have tended to attract more people than the Midwest. I think our projections of growth in the Midwest are for continued positive growth, but also continuing to be a bit slower than the national average. Part of that is because manufacturing is not struggling, but is facing a little bit of a rough patch, which is worth taking a 30-second diversion into.
Mm-hmm.
The normally most cyclical part of the economy is very much tied to durable goods and business investment, consumer durables, buying of cars, buying of washing machines, and a lot of manufacturing stuff is very interest rate sensitive and business cycle sensitive. So the Midwest is often a leading indicator when I talk about the look at the most affected industries. If you want to know where are you in the business cycle, you kind of go look at some of the types of manufacturing that were very intense in. This downturn in COVID was the first recession ever that wasn't driven by fewer purchases of durable goods and business investment. It was driven by people can't go to the dentist and they can't go to the movies or out to a restaurant because of the virus. So as everyone knows, there was a dramatic short run shift in what people spend their money on to physical goods because you literally could not spend your money on physical services. Now that's shifting back to the traditional pattern of more services. And that means that separate from the business cycle, there's a little bit of a pressure on manufactured goods that we're kind of phasing out some of the demand that was artificially high. So I think manufacturing's facing a little bit of a tougher spot. The logistics, transportation, those have been very strong. And if you get the list, I have the list here of the largest employers in all the states of the Midwest, except Illinois, where it's number 2. A healthcare entity is the number 1 employer in the state, private sector employer in the state. And in Illinois, it's number 2. So the healthcare economy is mostly recession proof, and it has been strong and continues to be strong. And as you know, the Midwest has a lot of expertise and intensity in that.
Right, for sure. What do you see in terms of the housing market for 2025? I know some articles I've read, not quoting you, but others have talked about, we'll never see interest rates as low as what they were. And maybe we're in a more normal, interest rate environment. How do you see that playing out along with the housing market in 2025?
Okay, I do think that if you say what were rates before, the rate was close to 0 and inflation was 2%. We had real rates of -2. So
Yeah.
I don't think we're going back to that. So de facto, I do think rates are going to be a bit higher than they were before, but I still think that what is neutral is below where we are now. We've been in a restrictive Fed funds kind of environment. What it means for housing is normally not going to be saying higher rates is tough for construction and it's tough for long-lived durable goods. A house is kind of the most durable good that people will purchase. Yes, though the thing I'm still trying to wrap my head around. In the short run, housing inflation has been the big puzzle. And the only thing that I would emphasize is that when people say, "Oh, my grandfather used to work a job, he had one job and he could afford these houses, which now are super expensive, and I can't even buy a place." And everywhere we go, Wisconsin, I've been to Iowa, Illinois, California. If you ask what's the biggest problem hiring people, they will say the cost of housing is so high, nobody can move here. And it's important to remember that before COVID, we had 2% inflation, even less than 2%. But that wasn't from 2% in everything. Goods were about -1%. Services were like 2 to 2.5%, and housing was 3.5 to 4% inflation every year for a decade before COVID. Okay, now I don't need to tell the Wisconsin Bankers Association that if you have something that if you just compare the price of housing to the price of the stuff that you can buy in Target, that's one of them's +3.5 and the other one's -1 per year. If you have a compounding 4.5% thing for 15, 20 years, the relative price of housing is a lot higher than it was back then. It's not wrong that people used to be able to buy better housing relative to what they could buy of physical stuff, because the relative price of housing has shifted dramatically over decades. That's happened in the last 2 years, but it didn't start in the last 2 years. A lot of economists argue that that relative price shift, uh, a key component has been there's just not been enough building, that we got to make it easier to build new houses if we want to make the prices more affordable. Um, but I think there's no question that going back to a more normal rate environment is also going to make the cost, not the inflation rate of housing, but just like the carrying cost of housing is going to make it higher. I think that's realistically where it's going to be. And you know that if you start talking to people of a certain age, they will say, you know, Gen Z will now say, oh, it's impossible. You know, my father used to be able to afford this house and I can't even buy a condo. And then dad will say, when I got my first house, the interest rate was 17%, you know, and
Yeah.
so there is a component of that on both sides.
Yeah, there is for sure. Right. Yeah. Our first house, it was 9%. So
Yeah,
it's
exactly.
all, it
Exactly.
is all relative that way. But yeah, I mean, affordable housing without question is a topic of conversation that spans all of the different states here. And we certainly talk about it a lot in Wisconsin. And, you know, there's no one easy fix to that issue at all.
Yeah.
Some of it is certainly zoning and local regulatory requirements. Some of it is, you know, the neighbors not wanting to see lot sizes shrink and more homes go up. But at the same time, it's just harder and harder to get labor to certain parts of our state or our Midwest region without more affordable housing, for sure.
Yeah, and look, it can't all be zoning. In Wisconsin, the unemployment rate is in the twos,
Yeah.
and you got some South Dakota people there, the unemployment rate is in the ones, and they're not generally associated with the same kind of urban zoning restrictions that you see in the big cities. I spoke at the Iowa Farm Bureau, and we were out kind of in more rural Iowa, and I said, "What's the biggest problem?" And they said, "House prices make it hard for people to move here." So I think we're going to have to confront that.
Yeah, for sure. We haven't talked much about the ag economy in specific here. What do you see in terms of agriculture generally? It's a very broad sector, obviously, and we're
Yes.
certainly seeing some of our crop farmers struggling more than perhaps, you know, cattle or beef or dairy. What do you see just in general with the ag economy in the upper Midwest?
It's been a tough year. I mean, if you look at farm incomes, it was a tough year, and it followed some blockbuster years, so that probably makes it even more. The adjustment is even more abrupt. You've seen in the dairy context and in the egg context, some of these natural disaster type issues are definitely affecting things, whether it's avian flu and affecting the price of eggs and getting into the dairy industry. I think we're going to struggle along a bit in this interim period where food inflation has come way down. Um, and think of that as the sales price, and input inflation hasn't come down as much as the food inflation has come down. So that to me makes it feel like there's going to be more of a squeeze, a continued squeeze on the ag economy.
Hmm. We had another question come in, I think a bit prompted by your point earlier that, you know, healthcare is the number one employer in many states in the upper Midwest. Do you think the healthcare provider industry is in crisis? We have seen, certainly in Wisconsin, hospitals and clinics in areas closing due to really serious financial difficulties. Some hospitals moving to more specialization business models rather than providing services to all. And then insurance reimbursements in many cases do not always cover the provider's full costs. Um, lot of crisis going on. Certainly, we've seen a lot of consumer opinion about that, especially after the tragic and very sad shooting of the UHC CEO in New York. It's a big price tag for consumers for sure. So, what do you see in this sector?
I mean, I'm by no means a health economics expert. Um, it has such a large share of employment and consumer spending that I have to pay attention on dual mandate grounds to
Yeah,
prices and output in that. It's probably not unfair. That's too many negatives. It's fair um, to describe, especially rural hospitals, as being there is a crisis of hospitals shutting down, and will the reimbursement rates, can they keep the lights on? At the same time, we have a shortage of providers, and it's impossible to get into medical school, and
right.
there's a lot of demand. So, not being an expert, I don't quite know why, but I do think there are a lot of challenges in that industry. And as just consumers of healthcare, everybody knows it's really, really expensive.
Right.
The impact on the inflation rate, as opposed to what's the objective cost level, inflation in the healthcare sector and the health insurance sector has actually been lower for the first time in a long time, lower than overall inflation in the economy. We went from many, many years, if not decades, where healthcare inflation rates exceeded overall CPI inflation. We've now gone through a period where it's at several spots it's been lower, but it's definitely expensive.
Yeah, yeah, it's another challenge that needs attention by probably lawmakers and others too. So, for sure. So we're nearing the end of our time here, and you are now in your position as president and CEO of the Fed in Chicago for 2 years. So congratulations
Yes.
on your 2 year anniversary. What has really surprised you the most about the job, and what have you
Uh,
enjoyed about it?
I have enjoyed the job. It seems like, wow, if there were ever dog years, those were 2 dog years. I
Yeah,
got in, we had Silicon Valley Bank collapse. Everybody said, is it going to be the financial crisis again? The predicting recessions, we've had raising the rates. I joked in my first, I think, 4 months, I voted to raise the interest rate 3 times, and it took my predecessor 10 years to do that.
right.
Um, the I've if you interact with your regional reserve bank, you will know what I had been told, but I have really come to learn. The people that work at the Fed are believers, and it's like the NASA of of economics or something. And I have loved that mission driven nature of the employees here, just so professional and really wonderful. And the biggest surprise, I kind of knew about monetary policy, of course, the world. I will say, going to the FOMC meetings, and the shades come down so they can't
Right.
spy on you. And there's a giant table, and we're going to go around the table, and Jay Powell is going to say what he thinks about the economy, and everybody's going to say is just about the coolest thing in the world, and is every bit what you would want it to be. Um, but that wasn't a surprise. The biggest surprise for me has been finding out that we have a giant vault of cash with like 30, 40 something $billion of cash. And each of the reserve banks has a massive cash operation. We are the bank to our member banks, and we're running hundreds of millions of dollars of cash and pulling the counterfeit and counting it and stacking it and bundling it. And that's been a real treat. I love that operational aspect of the bank. It's been a surprise.
Yeah, I'm sure the inner workings are all really very fascinating. And I'm sure the first time you were in that room out in DC, it must have felt pretty cool to be there for sure.
Yeah, it's a look. With no offense to the U.S. Senate, I believe that the Federal Open Market Committee is the world's greatest deliberative body
Yeah.
in the 21st century, and it's been it's a blessing beyond measure to be able to just hear the opinions and deliberate over what to do about the economy in the world. The universe is this big and the Fed's part is this narrow, but at least in that part it makes a big difference what the Fed does.
Well, and thank you very much for your representation of the district when you do go out to those meetings. It's much appreciated. You're clearly very thoughtful and deliberate in your research and in your analysis, which we appreciate as well. I want to thank you so much for joining today. This has been a great pleasure and an honor of mine to get to have this dialogue with you today. So thank you for your time. I do also want to again thank my peers for co-hosting today's event in the states of Illinois, Michigan, Minnesota, and South Dakota. I want to thank everyone else for your participation today. I will also echo your high comments about your team at the Chicago Fed Bank. I interact with several of them, and they're all great, devoted, very talented individuals. So appreciate all of their work and what they do to help support you and the rest of the bank as well. And then finally, want to thank our sponsors for sponsoring today, BOK Financial Capital Markets and Whipley LLP. So again, thank you so much for your time, President Goolsbee.
Thank you. It was a real treat for me. And thank you to the Wisconsin Bankers Association for all you do. We have a very robust regional economic effort, and we rely on communicating and getting the insights and observations from you and your members, and we've greatly benefited from that. So thank you for your help.
It's been a great mutual relationship for sure. Well, I hope everyone enjoys the rest of your day, and thank you so much again for your time today, President Goolsbee.